To me, it's almost like the circulatory system. I think that credit is like blood that brings nutrients to all of the parts of the body, and it passes through a system that is like arteries, and then credit creates debt. And the key question, if it's healthy, is does the debt create an income that is more than enough to service the debt? And that's like, I don't know, eating vegetables or something. It's a healthy process. And if not, credit begins to build up this debt. It begins to become like plaque in the arteries. And you can measure it, just like you could measure it in the arteries. And you can see how it constricts that circulatory system, because as credit and debt service rise, you see that it eats up more and more consumption because you have to spend that. So you could watch the government do that. You can see that how interest is eating up and debt service is eating up, and that means there's less money. And then you also can see how heart attacks take place. And they're very, economic debt heart attacks. And the way they take place is by looking at the supply and the demand. If you have a lot of debt and then you have a large supply of debt, that has to be bought. Somebody's got to buy it. And so that when you get to the point where there's debt risks, there's not only the new supply that has to be offered, but there is the possibility of holders of those debt assets selling those debt assets. And so the supply becomes overwhelming relative to the demand. And then what that means is it's the same dynamic for the government as it is for an individual or a company, except the government can print money. So when that debt service burden rise, or there's a big supply-demand imbalance, if the government, most importantly the central bank, doesn't print money and buy it, then there has to be a rise in the price of the debt to constrict borrowing. And that borrowing constricted, that credit that is not going to come, will weaken the economy and cause bad economic conditions. And so they can let that happen, or they can print money and buy the debt and monetize it. When they do that, that's inflationary, and it lowers the value of the debt. In either case, you don't want to hold that debt, because either there's a debt service problem or there's a depreciation. You get paid back with a greater supply and cheaper money. And that is the dynamics, and that's the mechanism. And because it can be measured, it can be seen in all countries, you can watch it happen. And so like you're going to your doctor, you can measure these things, you can see them, and you can know what needs to be done.
As we navigate into 2025, the financial landscape continues to unravel in ways most investors never anticipated. What was once considered unthinkable is now unfolding before our very eyes. Governments, central banks, and even high net worth individuals are scrambling to secure gold, revealing a fundamental truth. Trust in fiat currencies is at an all-time low, but let's step back for a moment and analyze why this is happening and what it means for the future of global finance. One of the most telling signs of a monetary shift is the behavior of central banks. Over the past 2 years, these institutions, traditionally the bedrock of fiat currency stability, have been aggressively accumulating gold at unprecedented levels. According to recent data from the World Gold Council, central bank purchases have outpaced even the highest years in modern history. The People's Bank of China, PBOC, for example, has been on a relentless buying spree, adding hundreds of tons of gold to its reserves each quarter. The official figures they report are staggering, yet many experts believe China's real holdings are far greater, hidden behind shadow acquisitions and strategic purchases outside the global reporting framework. The question remains, why are central banks hoarding gold while publicly downplaying its significance? The answer is simple. Gold has no counterparty risk. Unlike the US dollar or other fiat currencies, which rely on government trust and central bank policies, gold stands independent. It cannot be printed, manipulated through interest rates, or diluted by reckless fiscal policies. This alone makes it an attractive hedge against the growing risks of currency devaluation and economic instability. Beyond China, Russia, India, Turkey, and even Poland, have dramatically increased their gold holdings. The European Central Bank, ECB, traditionally focused on fiat-driven monetary policy, has subtly shifted toward gold as well, recognizing its enduring value amid growing concerns about debt sustainability in the Eurozone. The US dollar, once the undisputed global reserve currency, is now facing existential threats from multiple angles. While it remains dominant in global trade, cracks are forming in the system. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been at the forefront of efforts to de-dollarize trade, a movement that is rapidly gaining momentum. The recent expansion of BRICS, which now includes Saudi Arabia, the United Arab Emirates, Iran, and Egypt, has only accelerated the transition away from dollar dependency. One of the most significant developments in this transition is the increasing use of bilateral trade agreements that bypass the dollar entirely. China and Russia, for example, now settle a vast majority of their energy trade in yuan and rubles. India is settling oil purchases with the UAE in rupees, and even smaller economies like Malaysia and Indonesia have begun exploring similar arrangements. When a growing number of nations no longer see the need to hold US dollars for trade, it weakens demand for the currency and, in turn, undermines its value. As this de-dollarization trend intensifies, the Federal Reserve faces an impossible dilemma. Keep interest rates high to maintain dollar strength or pivot toward lower rates to prevent a financial collapse. Either choice has dire consequences. If rates remain high, the U.S. government struggles to service its $34 trillion debt, leading to potential default scenarios. If the Fed cuts rates, inflation reaccelerates, further eroding confidence in the dollar. Gold, meanwhile, remains the one asset that benefits in either scenario, rising both as an inflation hedge and as a refuge against debt defaults. The idea of a return to a gold-backed financial system was once dismissed as a relic of the past, but recent developments suggest otherwise. The BRICS nations have openly discussed the possibility of a gold-backed trade settlement mechanism, and while the details remain uncertain, the intent is clear. They want a system that is free from U.S. control. Even within the United States, voices advocating for a revaluation of gold are growing louder. Senator Cynthia Lummis has proposed revaluing U.S. gold reserves to offset national debt, a move that would immediately change the financial landscape. Other prominent figures, including economists and former central bankers, have suggested using blockchain technology to create a digital gold-backed currency, merging the benefits of sound money with modern financial infrastructure. If such a shift were to occur, it would mark a seismic change in global finance. Gold would no longer be just a store of value, but an active medium of exchange in international trade. Countries that have accumulated large gold reserves, such as China and Russia, would stand to benefit immensely, while nations still reliant on fiat currencies could face economic turmoil.
A good example was in COVID. There were two waves. The first wave was the COVID wave, in which they put out, the government wanted to, and actually did, deliver a lot more money to people, companies, than there was a loss of income. So they, first wave, a lot of that money. Where did they get the money from? They had to borrow it. The central bank then came in and lent them. That was the primary. Then the second, when President Biden was elected, there was a second wave of that after COVID. It was mostly like a universal basic income thing. In other words, hand people money and we're going to be better off. And so they handed people money, doing that same exercise again. And so naturally, all these people got a lot of money, and so they deposited them in banks, they went out and spent, and so on. And it therefore shouldn't be surprising that we had a big wave of inflation, and we also had a lot of banks buy government bonds, which they lost a lot of money on. And that was that crisis. So that's how the mechanics work. You can't get richer by making money. And the purpose of money...
Because purchasing power is what matters at the end of the day. What your money's worth, what you can actually buy with it.
That's right. And there are two purposes of money, which is as a medium of exchange and a storehold of wealth. Saving is very important. And if you don't have savers who has it as an effective storehold of wealth, then you don't have a viable long-term credit market.
Yeah.
People don't understand that the bonds become a bad deal. You need that, like any marketplace, You need purchasers and sellers to be able to have an efficient negotiation to achieve a balance without the government coming in and printing a lot of money and messing up, make a big mess. It's like they made very severe negative real rates.
Right.
And we know what happened with the severe negative real rates. And the government, while they were making the significant real rates, it was the government that was the big buyer. Okay,
Yes.
So the government takes it on and they make negative rates. So what happens is then you get everybody leveraging up.
Yes.
Then you've got a problem. And so that's how it works. And it's a global issue.
The way I see it, the global financial system is like a massive circulatory system, with credit serving as the lifeblood that fuels economic activity. This system has arteries and veins that transport capital, ensuring businesses grow, governments function, and individuals thrive. When it functions properly, credit facilitates productive investments that generate income sufficient to service the debt. This is a healthy, self-sustaining cycle, akin to a body nourished by proper nutrition and exercise. However, when credit begins to accumulate without productive output, when debt does not create an income stream that surpasses its cost, then the system starts to clog. This is similar to the accumulation of plaque in arteries, slowly restricting the free flow of capital and making the system more fragile. At first, this buildup is subtle and unnoticed. Governments, corporations, and households continue borrowing under the illusion that debt can perpetually fuel growth. But over time, as debt service obligations, interest payments, and principal repayments consume a larger share of income, less capital remains for productive investments, savings, and consumption. This is precisely what we're witnessing today. The rising debt levels in the U.S. and other major economies are absorbing an increasingly large portion of GDP just to service existing liabilities, leaving little room for new growth. In essence, we are witnessing the economic equivalent of an impending heart attack, where debt overload is suffocating the system. The U.S. government provides a prime example. Over the past few decades, federal debt has skyrocketed. Now, with interest rates rising, the cost of servicing this debt is becoming a major budgetary concern. When government spending is increasingly devoted to interest payments rather than infrastructure, social programs, or investments in innovation, the economy slows down. The private sector also feels the squeeze. Businesses rely on credit to expand, innovate, and hire. But when borrowing costs soar, companies start cutting back, leading to job losses, lower wages, and reduced consumer spending. The ripple effects are undeniable. One major indicator of an approaching financial crisis is the supply and demand dynamic in the bond market. When debt reaches unsustainable levels, governments must continually issue new bonds to cover their deficits. If investor confidence wanes and demand for these bonds declines, yields must rise to attract buyers. This leads to higher borrowing costs for everyone, from governments to corporations to individuals. And if current bondholders begin to offload their holdings, fearing a loss in value, the flood of supply can push yields even higher, triggering a vicious cycle. This is the precipice we are now standing on. Unlike individuals or corporations, governments have one key advantage: they can print money. When faced with unsustainable debt loads, central banks often resort to printing money and buying government bonds, monetizing the debt. While this strategy temporarily eases borrowing pressures, it carries serious long-term consequences. Excess money supply leads to inflation, eroding purchasing power and undermining confidence in the currency. The value of debt declines, not because it's being repaid, but because the money in which it is denominated loses its worth. We've seen this play out multiple times in history. The COVID-19 pandemic provided a recent example. In response to the crisis, governments worldwide unleashed unprecedented stimulus measures, flooding the economy with liquidity. Initially, this appeared to stave off a deeper recession, but the long-term effects were predictable. Inflation surged, asset bubbles formed, and wealth disparities widened. The U.S. Federal Reserve and other central banks found themselves in a dilemma: raise interest rates to combat inflation and risk triggering a recession, or keep rates low and let inflation spiral out of control. During the first phase of the pandemic, money was injected into the economy to replace lost income. Households and businesses received direct payments, loans, and grants. However, rather than being a temporary fix, these policies continued well into the post-pandemic recovery. The second wave of stimulus, particularly under the Biden administration, had the effect of universal basic income, free money distributed with little regard for long-term economic sustainability. As a result, people had more cash to spend, pushing up demand while supply chains remained constrained. Inflation was the inevitable outcome. Banks, flush with deposits, used this excess liquidity to buy government bonds. But as inflation surged and the Fed raised interest rates, the value of these bonds plummeted, creating a crisis for banks holding large amounts of low-yielding debt. This was one of the key triggers behind the banking instability we witnessed in 2023 and 2024. Banks that had been comfortable with their bond holdings suddenly found themselves sitting on massive unrealized losses. A crucial misunderstanding among policymakers is the belief that wealth can be created by simply increasing the money supply. True wealth is not measured in dollar terms, but in purchasing power, the ability of money to buy goods and services. If the supply of money rises faster than the supply of goods and services, inflation ensues, eroding wealth rather than creating it. This is why gold and silver have historically served as reliable stores of value. Unlike fiat currencies, which can be devalued through reckless monetary policies, precious metals retain their intrinsic worth. The role of money extends beyond mere exchange. It must also serve as a store of value. When money fails in this function, savers suffer, and economic stability erodes. A functioning credit market depends on people's willingness to save and invest. If confidence in fiat currencies diminishes, savers look for alternative stores of value. This is precisely why central banks, particularly in emerging markets, have been aggressively accumulating gold. They understand that in an environment of declining trust in fiat currencies, gold offers stability. Historically, when real interest rates turn negative, when inflation outpaces nominal yields, investors flock to gold. The 1970s provided a textbook example. During that decade, inflation soared and real yields were deeply negative. The price of gold skyrocketed from $35 per ounce in 1971 to $850 per ounce by 1980. The parallels to today's economic environment are striking. Governments are trapped in a cycle of debt and inflation, unable to rein in spending without triggering a severe economic downturn. Today, we see a repeat of those dynamics. The U.S. national debt is at record highs. Real interest rates remain negative, and global geopolitical tensions are driving nations to seek alternatives to the dollar. China, Russia, and other BRICS nations are actively reducing their reliance on the U.S. dollar, instead accumulating gold and establishing trade agreements in local currencies. This shift represents a significant challenge to the dollar's hegemony. The trend of de-dollarization is accelerating. As more countries seek alternatives to the dollar for trade settlement, demand for U.S. treasuries declines. This puts additional upward pressure on interest rates, making debt servicing even more burdensome for the U.S. government. It's a self-reinforcing cycle, and unless policymakers address the root causes, excessive debt and monetary expansion, this trend will only intensify. For individual investors, the key takeaway is clear. Traditional safe haven assets like U.S. treasuries no longer offer the security they once did. With real yields negative or near zero, the risk-reward balance has shifted decisively in favor of hard assets. Gold and silver, with their centuries-long track record of preserving wealth, should form a cornerstone of any portfolio seeking protection against monetary debasement. In 2025, we are entering a new phase of economic uncertainty. Central banks are caught between inflation and recession. Governments are struggling to manage record debt levels, and global power dynamics are shifting. The writing is on the wall. Gold and silver are poised to play a crucial role in the coming financial reset. The question is not whether the system will change, but how prepared individuals are to navigate it. Those who recognize the importance of sound money and take action now will be far better positioned for the turbulence ahead.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.